Well, guys, welcome back to the channel. Interesting Monday. We got a lot to talk about. This whole bank bailout thing is just getting crazier and crazier by the second. We are starting to realize that now we are heading back towards the 2008 ways of doing things, where if you do stupid, risky things with people's money and it all blows up in your face, there's no negatives. You just get bailed out by the Fed. They're willing to come by and help anyone who put their money in a risky bank, which is exactly what a lot of people did with SVB, Silicon Valley Bank. So this is a very interesting precedent that the Fed is starting. They are, in one hand, trying to be financially tight in order to lower inflation, in order to ease the labor market. And now, in the other hand, they are willing to pick up the tab for any of these stupid banks that go belly up, which we have a lot to talk about there. There was another one, Signature Bank. There was another bank that was down about 70% today. I can't remember the name of that one. Let's see if I can find it for you. But Charles Schwab, very large bank, Charles Schwab, this was very interesting to me, was halted down this morning. It ran down about 20%. It did end up bouncing today, but this is just evidence of the fear that is in the financial sector, and it is only just begun. This is kind of a really crazy day when you look at all the factors. You have the Fed coming out, willing to hold the hand of all these shitty banks. You have interest rates absolutely plummeting, or not interest rates, bond yields just absolutely plummeting today. The 2-year bond yield down 13% today. This is the largest 3-day drop. I mean, these yields, it was up at 5%. It is down below 4%. It has fallen a full percent in 3 points. This is the quickest drop since 2008 on these 2-year bond yields. Just absolutely insane. So the bond market now is telling us that the Fed is going to be pausing or even maybe cutting rates this next meeting, which is absurd, absolutely absurd. If you have any brain on your shoulder, in your head whatsoever, absolutely absurd to think that they would be cutting rates, because now their credibility is all but gone, completely gone. They are just flinching. This is them flinching at the first sign of trouble. They wanted to be big tough guys, and now first sign of trouble, they flinch and they bail everyone out. And now we have to ask ourselves, how many banks are going to be affected by this? Is this 2008 all over again? Are all of these banks doing these very risky things like Silicon Valley Bank was doing? This is something you don't find out until it's too late, until the banks do implode. Not like the big banks, not the Wells Fargos, the Citi, the Bank of Americas, those guys. But some of them maybe like Goldman Sachs, the Morgan Stanleys, these banks. Credit Suisse is another one, the Swiss bank that people were talking about that was going belly up. That was last year they were talking about this piece of shit going belly up. They still haven't, but I imagine there is a contagion, and I imagine the Fed is kind of shitting their pants because of this drastic bailout that they are doing. It's just absolutely absurd to think that. I mean, it's one thing if you invested your money in something and they threw it away, but what the Fed is doing is they're backstopping all depositors. So you have to, as this free market system we have, you can put your money wherever you want in any bank you want, but you have to do some due diligence. You cannot just completely blindly trust any institution. You have to have somewhat of a thought of, is this a good place to put my money? And now the Fed has basically said that anywhere anyone has put their money, we got it. We are going to ensure that. And now we know how stupid this is because the FDIC exists for a reason. FDIC insurance limit. Let's Google this. This is super interesting. I mean, I'm worked up. This is like the dumbest shit. This will be a thing that we look back at this day and think, wow, this happened. This was like the dumbest shit that the Fed could have possibly done. So FDIC insurance, FDR brought it, a little history lesson. FDR back in the Great Depression, back when banks were imploding, there was no insurance. So your money, if a bank went belly up and you had money in that bank, you were screwed. Your money was gone. They created this so that doesn't happen anymore. And it has a limit on each account of $250,000. That's how much is insured. So if you have any amount over, if you have $250,001, you lose $1. But basically, Silicon Valley Bank was mostly for tech startups. Why do tech startups go to Silicon Valley Bank? Well, because they are willing to give lines of credit to these very illiquid, or not illiquid, like insolvent, these companies that basically make no money. They're heavily in debt. A lot of these huge tech companies, not huge tech companies, but tech companies that had huge rallies back in the COVID days, back when interest rates were zero, because they could borrow for cheap from banks like Silicon Valley Bank. Wells Fargo, Citibank, Bank of America would not loan these companies any money because they can't be that risky. Silicon Valley Bank could, because they were willing to take on the risk, because why not if the Fed is just going to bail you out, right? So a lot of these businesses have their money. Silicon Valley Bank, they have over $250,000. I mean, obviously, these huge tech companies probably have upwards of tens of millions, 50 million plus. They're only going to get $250,000 up until today, up until the Fed said, no, you can actually go to the ATM and withdraw all 50,000, all 50 million. We're going to be there for you. So why is this a bad idea? Well, because now banks just get the green light, where banks should see what is happening today. They should see what's happening today and think, well, shit, maybe we should take a little risk off. Maybe we should be a little smarter about things. Why would they do that now? If the Fed is just they're gonna have their backs. Why should depositors not be a little smarter and consider the risk of where they're putting their money? If the Fed today is just saying, any money you have anywhere, we got it. We're gonna give it back to you. It's just crazy. This is just the beginning. This is the ball is already rolling. I mean, what's the word? I can't think of the analogy. But the ball's already rolling. You can't put the monkey back in the cage if that's the way you'd like to put it. This will be a contagion. This will be panic inducing. If we look at what stocks did today, so last night I talked about how interest rates are dropping. It's looking like the Fed is not going to do the 50 basis point is off the table. We were at a point where it was like 80% chance we're getting that 50 basis points. Now, if we look at our Fed Watch tool, we will see that this has just been going up, that we are going to stay at 450 to 475 basis points, that we will not get a hike at all. This is crazy. So not only is the Fed willing to turn on the printers to backstop these banks and depositors at these banks, they are willing to now ease up, or at least that is what the bond market is thinking. We haven't heard from anyone at the Fed about what they're planning on doing at the next FOMC. We haven't heard from the Fed on the FOMC in a few days, so I'm sure a lot has changed. We haven't heard anything, though. They've only come out and said, yeah, we're going to backstop these banks. So right now the bond market is saying we will not be getting a rate hike this next FOMC meeting. Why is this a big deal? Well, because tomorrow we get that CPI data. So if CPI data comes out hot tomorrow, I think it's expecting headline to be 6.5 year over year, 6.5% CPI headline year over year. Down from 6.6. So that is a 0.1% drop that they're expecting. So we're dropping at 0.1% year over year every month. That's how sticky inflation is right now. So we get that hot CPI data, and then we get a Fed that is going to pause. Are they just saying inflation is fine? Bank runs are scarier than inflation? That is exactly what they're going to be telling the market. Inflation will not go anywhere if they start to pause their rates, if they don't continue to press their foot on the gas. But if they continue to put their foot on the gas, then these banks are going to struggle, and the bank run situation can get worse. So now it's is this worse than that, or should we do this or that? Right now, the bond market thinks they're going to be dovish and they're going to cut, and they might even pause their quantitative tightening. If you guys know about that, I've talked about that. They're rolling stuff off their balance sheet. Their $9 trillion balance sheet. They've rolled off maybe like $800 billion since this time last year. So if they pause that, if they pause rate hikes, that will be them saying inflation is okay at 6%. And it's okay for banks to do really stupid things with people's money. And when they get caught, we're going to bail them out. So this is just an absolute nightmare. With that news, the S&P could even close green today. So this tells me a lot today, what the S&P did today. Tech is very strong. Tech was on a bender today. It went crazy today because tech loves low interest rates. It loves when their banks get bailed out. How many Nasdaq companies were in the SVB, I wonder? I'd love to find that. Or maybe not Nasdaq 100, but just total stocks on the Nasdaq exchange. I'd love to find that out. I wonder if there's any statistics on that. But tech loved this. The S&P 500, I mean, it was red today, but you can really blame that on the financial sector. XLF was down 4% today. XLE also was down 2%. So Dow Jones, yeah, industrials weren't looking pretty. Ugly day on the Dow Jones. So S&P 500 below that 200-day moving average, and now trying to push up to 390. You can see we tried. 390 is the brick wall right now on the S&P 500. We tried, couldn't do it. So we're still below that 200-day moving average, still looking bearish. Nasdaq, however, held up on its 200-day moving average, but also ran up to 294.50. That is the brick wall on the Nasdaq. If we look at our hourly, you can see this super clear. Super clear supply still right here. And that is the wall to break if we want more upside on the Nasdaq. To the downside, it looks like we got some big old support. And if we actually, let's look at the futures, because I actually already put these things I thought I did on the futures. Ran down there. Look at that. Look at that right there. How about that? Ran down to that demand perfectly. And that's the line to break on the Nasdaq now. 1181 basically is the line to break on the Nasdaq. Below that, we still have another demand zone down at 1169 or basically 1170. So that's what the Nasdaq did today. You can see where we ran up to that supply. I told you all about that supply yesterday, man. That was perfect today. That was a perfect entry on puts right there. We tapped it. We ran up into it. 2 wicks up to that upside. I mean, this trend line was money. Drop a like, please. I would just ask you to consider dropping a sub and a like if you learned anything at all. But crazy, just crazy day. One of these days where it's just like, man, this is, it's really sad. Honestly, it's sad that this is the world we live in. This is 2008-esque all over again. Not nearly as bad as 2008. All the big banks were about to collapse in 2008. They had to bail out the banks. They were literally all on the brink of collapse, besides maybe JP Morgan and Bank of America and Wells Fargo. But this is that all over again, where in 2008, pre-2008, they were given all these risky things. They were doing incredibly risky things, and they were all doing it because if you're Wells Fargo and JP Morgan's doing these risky things, and you're Wells Fargo and you're like, I don't know if I want to take that risk. Well, the shareholders didn't even know about it. So the shareholders just see how much more money JP Morgan was making. So Wells Fargo is like, hey, we got to do this. This is just an analogy, not literally what happened, but this is always what happens. The whole industry, they're going to all do these risky things because everyone else is doing it. So if you're not going to do it, you're going to fall behind as a bank. And then the Fed comes in and says, yep, just keep doing it. Just keep doing it. We got you. We got you. It's absolutely infuriating. It's complete embarrassment. The Fed... People talk about the Fed's credibility, and now it's just like we can't even put the word credibility in the same sentence with the Fed. They have zero credibility. If they are willing to start cutting rates and pausing quantitative tightening, the second one of these shitty banks with terrible risk management, no hedging in a high interest rate environment, if they're willing to just drop everything and throw it all to the wind just because one bank, I mean, not one bank, multiple banks, but just because that shitty bank went under is just an absolute joke. So, like I said yesterday, I think they see something that the public is not seeing. They're not going to tell us about it, obviously, but they are seeing something we're not seeing. They are seeing a panic crash coming, and they are trying to prevent that. With a panic crash would come bank runs, and it's just a contagion. It's all psychological, because for a year straight now, people have been hearing times are going to be tough. Recession. People think recession. They remember 2008. What happened in 2008? Everything went tits up. Everyone panicked. So everyone doesn't want to be late to the panic. Everyone wants, if you're early to the panic and you get your shit out, like if you were a banker at SVB or a depositor, although this in hindsight doesn't really matter because the Fed is going to backstop everything. But if you heard that there was trouble at SVB and you panicked first, you got your money out of there first, you were rewarded, because if you didn't, people thought they were going to lose everything. But now we know that's not true. So that is why this contagion of panic is so volatile. It can just get out of hand so quickly. And this is the Fed trying to stop that. But the market reaction we got today was not even a green day on the S&P 500. It couldn't even squeeze out a green day. So that to me is very telling. This is very clearly, we're in the micro denial stage of, nah, things are good. Things are good. We're not going to get bank runs. Things aren't going to get worse. Everything's fine, which we know how this will end. This always ends up being bearish news. When you see bond yields just plummeting, I mean, bond yields going up was bad. It was pulling down the market because that meant higher interest rates from the Fed. But when you see bond rates yields doing this is not good. This is people are taking their money and they're throwing it into treasuries because they are scared shitless. They need that safe investment. So this will end up being bearish from the weeks to come. I don't know what the rest of this week will do. I don't know what tomorrow will do. I'm expecting CPI will come in red hot. All signs point to inflation is still as high as it's ever been. So I expect if we get high CPI, but then we get a Fed that comes out at FOMC and doesn't jack up interest rates, I think that could be a start of a new bull market. But it will be a short-lived one. It will not be like another 10 or 12-year bull market. It will be, we go up for maybe 6, 9, 12 months, and then shit really starts to hit the fan. Inflation really becomes unanchored. We start to see inflation just absolutely getting out of control. And then the Fed will be sitting there being like, well, shit, we tried to jack up interest rates, but it almost broke something. But now inflation is breaking everything. So it is a very, very interesting position that they're sitting in right now, and it really just goes back to 2008. I mean, the rich, as soon as the rich are in any trouble, they get bailed out. But inflation at 8% is catastrophic for the middle class. If inflation stays at 8% year over year, or 7 or 6%, that's catastrophic for the middle class. They're losing their asses on that. But the system doesn't care about them. It cares about the rich people. Always has, always will. This is proof of that. Because, hey, if the middle class is losing their jobs, they're losing all their money. Oh, boo-hoo. But, oh, shit, the big banks. Oh, damn, those big rich folks at the banks, they almost lost a lot of money. Whew, we best bail them out. That's always how it goes. So it's an unfortunate reality. It's very sickening. And I don't think anyone should look at this and be like, wow, this is a good day. This was a good day today. I'm glad about what the Fed is doing. I don't know how anyone could look at this and be like, yep, the Fed did the right thing here, because they are just absolute clowns at this point. They have no credibility whatsoever. Just complete clown show. So if we look at the S&P 500, we got a big old wick on this daily candle. It looks ugly. It looks disgusting on really high volume. But Nasdaq, nicer. We close above that 200-day moving average on really high volume. This, to me, is just the gut-wrench reaction of tech has to go up when interest rates go down. I expect, as systemically things get worse, that won't be the case. But for the short term, it looks bullish. Who knows what CPI will do tomorrow morning? That's going to be incredibly volatile. Which, speaking of volatility, look at the VIX. At one point, the VIX touched 31 damn near today. It shot out of a cannon. So we know what the VIX does. This is what the VIX always does. When it breaks out and does this, it doesn't usually just stop at like 28. It usually heads for these high 35s, 36 before it begins to peter out. And we have our trend line right there where it has kind of tapped that perfectly multiple times. So I expect the VIX to at least get to 33 before the end of this. If we get a red hot CPI tomorrow, I expect that will do it. It could be flash crashy tomorrow. This could have just been the calm before the storm, if you will. But who knows? It's just gambling. If you really took any huge, meaningful swing positions. Right now, I'm short Nasdaq out until July. I got puts. I just personally don't see how this ends well. But if the Fed does come out and they say, yeah, we're going to cut rates, we're going to turn the printers back on, then stocks will go up, and there's just no denying that. So my risk to reward is really tight right now. I'm still short on NVIDIA. NVIDIA couldn't hold 232. It closed perfectly sideways. Say that's crazy. So NVIDIA, to me, it still looks great to the downside. You can see, wow, it tapped that 200-hour moving average perfectly. Holy shit, that's crazy. You see that wick down to that? Hot damn. Perfect on that. That's crazy. It's crazy, yo. But we lose this 50 moving average on the 4-hour chart. You can see where we have broken that, stayed above it, tapped it. When we break it, tap. You can see the significance of this. We tested it over here. We tested it today. We closed below that at 226, and NVIDIA looks even better to the downside. It filled some of its gap today, but immediately jacked back straight up. So NVIDIA in my opinion, still looks good. I'm cutting losses if we break back above 243 on NVIDIA, honestly. I got really far output, so it won't be terrible, but I'm looking for a big move down on NVIDIA, honestly. 170 is really my target on NVIDIA. I think we at least retest 170 before this is all said and done. Apple today was so strong. Apple, I don't understand why it was so strong today. No one knows. Well, actually, it wasn't the strongest one. Microsoft was even stronger today. But all these daily candles, just massive wicks to the upside. So we saw where buyers pushed it up and where sellers yanked it back down. So Apple, I said I'd probably cut if we broke above 150, but the daily wick on this was just so disgusting. In my opinion, Apple still looks good to the downside. We are still just holding that 200-day moving average. We break below that, 147.56. I expect more downside on Apple. My downside target on Apple is at least to 142, and I think I might take profit on that if we get there. So that is what I'm looking at here. That's about all I got for you guys. I appreciate if you drop a like and drop a comment. Any comments are great. I appreciate all of them. Right now, this is just such a crazy time. No one knows what's happening. If you're a bull, you're bullish because you're like, they're going to start pausing interest rates. They're going to turn the money printers on. If you're a bear, you're bearish because they're going to pause interest rates. They're going to turn the money printer on because if they do that, inflation gets out of control. But we know that just because inflation goes high doesn't mean stocks can't go up. It's not inflation that brings down stocks. It is the Fed's reaction to inflation. So to me, it is cataclysmic if they start to pause interest rates because inflation just 100% will become unanchored. 100%. It will get out of control. We will repeat the 80s if they do that. So thank you for watching. I will see you guys tomorrow. I will try to get up early for that CPI read. It's up at 5:30 in the morning for me, so nice early weekend, but we'll try to make it. I'll see you guys on the next one. Peace.